Most people think they understand their credit score. They know it's a number between 300 and 850. They know higher is better. They know missing a payment is bad. But here's what most people don't know. There are 5 specific factors that make up your credit score, and they are not weighted equally. One of them accounts for 35% of your entire score. Another one, that almost nobody talks about, accounts for 30%. And there are 2 factors that most people have never even considered that can silently drag your score down without you doing anything obviously wrong. By the end of this video, you are going to understand your credit score better than 90% of Americans. And more importantly, you're going to know exactly which levers to pull to move it in the right direction. Everything in this video is for educational purposes only and is not financial advice. Credit scoring models can vary between lenders and bureaus. The breakdown we cover today is based on the FICO score model, which is the most widely used in the United States. This is video 4 in our personal finance series. If you're new here, start with video 1, link in the description. Let's get into it. Your credit score is a 3-digit number, ranging from 300 to 850, that tells lenders how risky it is to loan you money. That's it. That's all it is. A risk score. But here's why it matters way beyond just getting a loan approved. Your credit score affects your mortgage interest rate. On a $300,000 home loan, the difference between a 620 score and a 760 score can be over $200 a month in mortgage payments. That's more than $70,000 over 30 years on the exact same house. It affects your car loan rate, your apartment application, in some states, even your job application, and increasingly, your insurance premiums. A lower credit score in many states means higher car and home insurance rates. This number follows you everywhere. Understanding it is not optional. Your FICO credit score is calculated from 5 factors. Let's go through each one, starting with the most important. This is the single biggest factor in your credit score. More than anything else, lenders want to know one thing. Do you pay your bills on time? Every on-time payment builds this score. Every late payment damages it. And a payment that is 30 or more days late gets reported to the credit bureaus, where it can stay on your record for up to 7 years. One missed payment on an otherwise clean record can drop your score by 60 to 110 points overnight. The fix is simple, but non-negotiable. Set up autopay for every account. At minimum, the minimum payment. You never want a missed payment to be the reason your score drops. Not when it's this easy to prevent. This is the factor most people underestimate, and it is responsible for more unexplained score drops than almost anything else. Credit utilization is the percentage of your available credit that you're currently using. The formula is simple. Your total balances divided by your total credit limits. Example, if you have a credit card with a $5,000 limit and you're carrying a $2,500 balance, your utilization is 50%, the target. Keep utilization below 30%. Ideally, below 10% if you want an excellent score. Here's the important nuance. This is calculated on both your total utilization across all cards and on each individual card. So even if your overall utilization is fine, one maxed out card can drag your score down. 2 quick ways to improve utilization without paying off debt immediately. 1. Ask your card issuer for a credit limit increase. Same balance, higher limit, lower utilization percentage. 2. Make a payment mid-month, before your statement closing date, so your reported balance is lower. This factor rewards patience. The longer your accounts have been open, the better, because it gives lenders more data to assess your reliability. 3 things matter here: the age of your oldest account, the age of your newest account, and the average age of all your accounts. The practical implication: never close your oldest credit card, even if you don't use it anymore. Closing it reduces your average account age and your available credit limit, which also hurts your utilization. Just leave it open. Put a small recurring charge on it, like a streaming subscription, and pay it off every month. If you're young and just starting out, you can't speed this factor up. Time is the only fix. But you can stop making it worse by opening too many new accounts at once. Lenders like to see that you can handle different types of credit responsibly. Credit mix looks at whether you have a variety across 2 categories: revolving credit, like credit cards and lines of credit, and installment loans, like car loans, student loans, mortgages, and personal loans. You don't need every type, but having at least one of each generally helps your score compared to having only one type. This is only a 10% factor, so don't take out a loan just to improve your mix. It's not worth the debt. But if you already have both types, know that they're working in your favor. Every time you apply for a new credit card or loan, the lender does what's called a hard inquiry on your credit report. This temporarily drops your score, usually by 5 to 10 points, and the inquiry stays on your report for 2 years. The practical rule: don't apply for new credit unless you actually need it. And if you're planning to apply for a mortgage or car loan in the next 6 to 12 months, don't open any new accounts in that window. Every hard inquiry in that period is a small drag on the score you're trying to maximize. One exception: rate shopping for a mortgage or car loan. Multiple hard inquiries for the same type of loan within a short window are typically counted as a single inquiry by FICO. So compare rates. Just do it within that window. Now let's talk about what these score ranges actually mean in real life. 300 to 579, poor, likely to be denied for most credit products. 580 to 669, fair, approved for some products, but at high interest rates. 670 to 739, good, approved for most products at reasonable rates. 740 to 799, very good, competitive rates, better terms. And 800 to 850, exceptional, the best available rates on almost everything. The meaningful jump is from below 670 to above 740. That range is where borrowing costs change dramatically. Here's a real example. Two people apply for the same $30,000 car loan over 60 months. Person A has a 620 score. They get a 9.5% interest rate. Monthly payment, $632. Total paid, $37,920. Person B has a 750 score. They get a 5.2% interest rate. Monthly payment, $571. Total paid, $34,260. Same car, same loan amount. Person B pays over $3,600 less just because of their credit score. Multiply this effect across a mortgage, multiple car loans, and insurance premiums over a lifetime, and a good credit score becomes worth tens of thousands of dollars. Before we wrap up, let's kill 3 myths that cause real damage. Myth number 1, checking your own credit score hurts it. False. Checking your own score is a soft inquiry. It has zero impact on your score. Check it as often as you want. Use Credit Karma, Experian, or your bank's free credit score tool. Myth number 2, carrying a small balance on your credit card builds your score. False. This is one of the most persistent myths in personal finance. Carrying a balance costs you interest and does nothing positive for your score. Pay your balance in full every month. That's the optimal move. Myth number 3, closing paid off credit cards improves your score. False. Closing a card reduces your available credit, raises your utilization, and potentially lowers your average account age. All 3 hurt your score. Leave paid off cards open. Let's recap the 5 factors one more time, in order of importance. 35%, payment history. Never miss a payment, auto pay everything. 30%, credit utilization. Stay below 30%, ideally below 10%. 15%, length of credit history. Keep old accounts open, don't close them. 10%, credit mix. Revolving and installment credit both working in your favor. And 10%, new credit. Don't apply for credit you don't need. Your action step for today. Go check your credit report for free at annualcreditreport.com. Look for any errors, incorrect late payments, accounts you don't recognize, wrong balances. Errors on credit reports are more common than people think, and disputing them can raise your score quickly with no other changes. In the next video, we go even deeper. I'm going to show you the fastest, legitimate ways to raise your credit score, including a few moves that can show results within 30 days. If your score isn't where you want it to be, that's the video to watch. Subscribe so you don't miss it. See you in the next one.